Well, let's get across what happened overnight and a bit of a look to what we can expect today. Zach Riaz is joining us from Banyan Tree Asset Management. Thank you for joining us.
Morning.
Nice to see you on this Tuesday. Record finish in New York, record heights for gold as well. It's pretty incredible.
Yeah, look, pleasingly, we did jump on the gold bandwagon a long time ago when it was around $1,700. And look, it's actually broken through our price target of $3,500. And it looks like it's going to break out further higher even from here. I think some of the interesting things is one of the reasons we really think the gold price was going to be structurally different going forward was just how investors were thinking about duration, sovereign bond yields, and treasuries in particular in their portfolios. And honestly, that really came back from our work that we did on our multi-asset side, right? So obviously we run direct equity strategies, but the multi-asset side. And one of the things we found in our own portfolios, we were finding a bridge too far for us to include duration into portfolios right now as a genuine defensive. And therefore, we were looking for a genuine safe haven. And the only thing that was coming up as trumps was gold. Mm-hmm. And you've seen that. A lot of people discuss, well, how do you value gold? It's got no real underlying cash flows, et cetera, et cetera. But at the end of the day, for a very long time now, gold has been the standard as a safe haven.
So do you gain exposure, though, via a physically backed gold ETF or via an ETF that hits some of those global gold miners, or do you do it company specific?
Yeah, no, so we've been basically, up until recently, we've been hitting it with the gold ETF. And I think that's another important thing to understand. We learned very early on in our lives that expressing some of the macro views, and we do this all the time in our global and Australian equity strategy, sometimes the macro thematic that you're playing through bottom-up stocks often gets lost because of the equity risk. Pretty common knowledge, right? And we found that was often the case with gold. And so we were very cautious of playing gold, the thematic, through ETFs or stocks. So it's been through an ETF predominantly, but recently we started adding Northern Star resources. That's been our go-to gold strategy. But yeah, we've been very, very focused on just making sure as clean exposure to gold, the gold price itself. But I think where we are now, and with how much gold has rallied, I think you really got to make sure you continue to take profits.
Oh, okay, yeah.
And that's, I think, the point that we're trying to get across now, that, all good things come to an end. We don't think gold starts to decline materially from here, but I think it probably takes a break of sorts. So I think where we are today, you want to start taking a little bit of more profits along the way. What's very interesting is that we've spoken about this before. Tourists start coming in when you start getting momentum in a particular asset class or a stock. But what's really interesting about gold is now, if you look at the funds flow that typically would go to US Treasuries, mm-hmm. or long-term bond yields and duration assets, right? If you just take some of that interest or buying pressure and put it towards gold, I think there are estimates out there that gold could get up to $5,000.
Well, that's what I've heard.
Yeah, and I think Goldman Sachs came out
and
said that. Now, I haven't read the report, but that in itself also starts to make me a bit nervous, mm-hmm. when you certainly have ridden the wave. And so this is a really good chart. Just shows you that even investors looking for a genuine diversification through long-term duration assets just haven't had the benefits that they were seeking. And so these are bond yields, sovereign bond yields, across the world, year to date. That's how much they moved. And what's very interesting is, as someone pointed out, US bond yields are actually pretty much just flat, which means, mm-hmm. the valuation hasn't moved too much. This is despite all the talk about fiscal, yeah. and stuff.
Okay, so gold being a watching brief, but take profits where you
absolutely,
can.
You got to keep, yeah.
All right. Now, another major driver of market sentiment right now is the baked-in expectation for a Fed cut coming next week.
Yeah.
Some are saying even a 50 basis point cut. You can weigh in on that. But the bigger question is, if it's priced in, markets are close to all-time highs, as I mentioned, setting further records overnight. Like, Will it make a difference in terms of equity momentum?
We love a good data. Just very quickly, we think they should go 50 basis points, but I'm sure there's a lot of other people that will be on your show discussing that. But the only story in town right now is basically the Fed will start cutting, and that, you know, we do valuation, bottom up valuations ourselves, and I can tell you, if I cut the long-term bond yield by 50 or my risk-free rate by 50 basis points, it's making my valuation of a particular stock move by 15 to 20%, depending on my earnings estimate. So it has a real implication. But this is a really good chart. I mean, well, good data. And this basically goes, because a lot of people are saying, well, it doesn't really matter. It's already in the price, the current cut. So we've already had that rally. But this data goes back for the S&P 500, 20 years, 19 or to 1980. And it shows that every time the US Fed has cut when the market has been 1 to 2% from all-time highs. And it shows you that on every occasion when the Fed has cut, despite the market being 1 to 2% from all-time highs, when they did the cutting, it was up 1 year. Yeah, I mean, that's a pretty good strike rate. Now, again, I want to bring it back to fundamentals, and let me explain it to you. Like I said, we were doing a valuation on Ferrari race, a global equity strategy, a global equity listed on both in Italy and in the US. We moved the long-term risk-free rate by 50 basis points, and we went from a hold to a buy with potentially 20% upside. So, I mean, some may suggest, well, this is just data. There's no fundamentals behind it. But let me just add that fundamental bit to it, that if you see, like Powell said, 100 basis points is where the neutral rate is. Mind you, neutral rate is another interesting thing.
Oh, we don't have time for neutral rate today.
But anyway, the point is, if we're going to get 100 basis points cut to where the neutral rate is, valuation will momentarily get up.
Okay, so let's bring it back home then, because in this environment, where do you look for value in this market?
We're looking both ends. Like, look, I've got to say, from this reporting season, some of the real value stocks have just struggled because there's issues around them, right? So, and then the real good stocks with earnings momentum behind them, despite their earnings not being as attractive as we would have thought, but just being really, really well supported. So we run a core strategy, so we like to look across the divide. And the two names that we really like right now and are playing in our portfolios is AGL, so that's your value play. And the simple story there is, look, earnings growth, if you look at the EBITDA growth, that's still growing at a half decent rate. It's not thumping the table, but it's growing at a half decent rate. FY20 results, what you saw was a reset of depreciation and amortization and higher interest costs. But that should be now in the expectations. And more importantly, the battery earnings are starting to come through. There was about $30-40 million already in FY25. The investment that's going in there is obviously hurting the bottom line right now, but I think a yield of 5.5%, battery starting to come on, expectations reset. I think at $8, we get this is a really good risk reward. And let me just give you a little bit of a sense check around the valuation. Our EV/EBITDA valuation is done at 4.5 times, which we don't think is a very large multiple, and our PE multiple is done at 10 times. You're getting a 15-20% upside. So really good risk reward here. And so AGL is one we like. And the other one that we like, if you're looking for one that actually has good earnings momentum, not too many headwinds besides execution, is PEXA.
Okay.
Yeah, we've been really pushing PEXA at $11, $10 to $11, and so our last price target was $13. It's obviously smashed through that, and that was in April this year. And so we've just published a note. We own the stock in our portfolio. We've got a price target of $17.70 or thereabout. So another about 10% upside. But look, from our perspective, I mean, we're not a broker. I'm not trying to push this stock onto you, but that's where our valuation is, and we think there's a fair bit of momentum in the UK adoption story.
Yeah.
And I think you could very easily get a price or valuation of $20. So good earnings momentum, good execution. The new CEO has got his feet under the table, seems to be doing well. One's a value play, one's a bit more growthy for you.